That's great. All right. Well, thank you so much, everyone, for joining us today. And especially if you're in the Eastern time, thank you so much for sharing your lunch hour with us. Thank you to Nolan and to the Capital Angel Network for giving Easily the opportunity to speak today and present a webinar on securing capital, a best fit approach. Those of you who don't know me, my name is Julie Cassandra. I am an account executive with Easily and I'm based in Ottawa. And today with me, I have Alastair Nimmons, who is Easly's VP of Business Development, and he is based in Vancouver. Getting access to capital is an important issue that most companies experience sometime in their life cycle. And the question is, which sources of capital are right for you and your business? Before we get into the agenda and the presentation today, let me just tell you a little bit about Easly really quickly. So we've been operating in Canada since 2019, and we are an online lending platform. We specifically finance government incentives like SR&ED and other government-backed grants. And the companies we deal with are typically small to medium size, and they all need capital to grow their business. To date, we have financed over $40 million to approximately 100 Canadian companies. Today, we'll be talking about how to optimize your capital stack and discuss some typical sources of capital. We will look at pros and cons of different capital sources to help you determine the right fit for you and your company. And then finally, we'll take a look at how Easly fits into the mix with our capital as a service approach. As Nolan mentioned, if anyone has questions during the presentation, please type them into the chat. And we will pause for questions after Alastair's portion and then again at the end of the presentation. So with that, Alastair, I'd like to pass it over to you.
Great, thanks for that introduction, Julie, and hello to everybody on the call today. So let's start with a definition. As Julie said, when we talk about securing capital, we tend to use the term capital stack and talk about optimizing your capital stack. And simply put, when we say capital stack, what we mean is the total capital used to fund a company. Or putting it another way, no matter what the source, if you add up all the money a company has at its disposal to fund its operations, that's its capital stack. And the term stack comes from thinking that a company's capital will most likely come in at different times from different sources and can look like different layers building up on top of one another. So you'll see this stack diagram a few times through the presentation as we go today. So, this isn't going to be news to people on this call, but a company's capital stack is normally made up of at least 2, if not 3 types of capital. Equity is usually the first piece of capital that a company has. It's often in the form of founders' savings or those of friends and family, or then into angel investors, perhaps. Debt doesn't take too much explaining. You borrow money from a lender and pay it back over time with interest. But then there's other. And you might say, what's in the other category? Well, it could be crowdsourcing, if that's applicable to your business. But for most folks, it's really government grants, tax incentives, government funding of one shape or form. So if we look at those 3 buckets of capital, it is pretty obvious that each has its own characteristics. But if we take each one in turn, it's also obvious that they break down into other categories or subcategories. So fairly quickly, we're dealing with 8 or 9 categories rather than just the 3, and getting the best fit for your company just got that bit harder. Equity, for example, if we look at that, as you go into securing larger sums of equity, whether it's preferred or common, those are most likely going to be externally provided and may take quite some time and effort to bring in. On the other hand, retained earnings within equity are internally generated, but obvious point, they are only generated when your company is earning a profit and can therefore also take time to acquire. Debt for startups can be hard to acquire because it can be hard to service if you don't have the cash flows. And although some banks will offer perhaps deferred repayment schedules, they're typically going to want to see some sort of revenue to show that you can pay off the debt and the interest over time. And they'll also likely be looking for some hard assets to secure the loan against. And if the company itself doesn't have the hard assets, then they'll be asking you, perhaps as the owner, to be putting up personal assets. And that can be comfortable or uncomfortable for some people. In the other bucket, as I said, crowdsourcing can be in there, especially if you've got an early stage product or other enticement that you can give away to funders. For most, though, the majority of opportunities here are in the form of government grants and tax incentives. Things like investment tax credits and refunds from the SR&ED, the SR&ED program, or from bodies like Sustainable Development Technologies Canada, SDTC, supercluster projects, CAN export program, Innovation Solutions Canada, where the federal government's operating as your first purchase order and first customer, that kind of thing. So if we look back at our capital stack again, you can start to see the layering effect that can take place. So if you've got a loan coming in, a term loan, say at 4 or 5% interest rate, it'll be at the lower end. But if you're selling off part of your company, no surprise, that's going to be more costly. And we've got it here at 30% or more, with equity coming in at the higher end. So over time, you can see that different sources, certainly on the debt and equity side, start to layer in at different rates of risk and return. And this will come back again when Julie starts to look at where easily fits in as well. So, you might say, okay, fine. What do I do with that? And the easiest thing to say is, well, you solve for the lowest cost and the most benefit out of all those options that are available to you. And while that can be easy to say, most people think about the direct costs first of all. What are the interest payments on a term loan? How much am I giving away if I'm raising equity? That type of thing. But there's always going to be other considerations as well. Some of them are here, what amount of capital can I get from each source? Will it start to dry up over time? How long is it going to take me to acquire it? What sort of process do I have to go through? What's the management time required? A fairly simple example, if we just think about it, say you're a life sciences company conducting research into a specific form of cancer, and you're looking for, 25, 50 million to secure lab space, buy supplies, pay people salaries, that kind of thing. There's plenty of private sector and government sector grants available, maybe from $100,000 to $1 million at a time, but each one has got its own application process and will take quite some time, 50 hours or more maybe, to apply for. So you could be successful in applying for those grants, and certainly that could be a way to go if you don't want to take on the burden of the debt and the interest payments or give away your future profits in terms of equity. But the real question is, how much time is it going to take for you to secure those grants? And it could be considerable amount of time, and you'll almost be in the grant application writing business rather than the cancer research business. So it may make sense to look for an investor or a group of investors to provide some or all of that money that you're looking for. A fairly simple example. Looking at another way, if you're in a different business and you get a government grant for $1 million to build a very specific widget, say, then guess what? Your company is in the very specific widget building business, because you need to make sure you build that in order to get the grant and keep the money coming in. And if you extend that to multiple grants to do slightly different things, then you may find yourself in slightly different businesses, and therefore more management time required to manage through that. So the point is, while it's pretty obvious what the direct costs of each type of capital are, you just need to think through what are these other surrounding costs and the indirect costs at each time. There's always going to be trade-offs when you're looking at funding your business through these different sources of capital. I know this looks more like an eye test, perhaps, rather than a corporate finance roadmap. But the point is, if you're only focusing on minimizing those direct costs, then you might be missing other things that are involved here. The direct costs, as we said, for equity of, what are you giving away? How much of the company are you selling? What's the valuation you're getting? Are you just giving up some control over your company? Or on the flip side, are you getting expertise from the specific investors that you're bringing in? For debt, the obvious ones are the interest rates and fees, maybe some other direct charges. But are you clear on what the cash flow burden of servicing that debt is going to be over your business and how you're going to afford it? So finding the right source of capital involves more than those direct costs. And thinking about this more holistically, as I was saying previously, some of the questions you should be asking yourself here: how much time and effort are involved in getting each of these types of capital? What will you have to do to prepare for diligence in order to secure them? Who's going to actually work on that? How much will you be able to get from each source? Does it limit your ability to raise additional capital in the future, or does it make it easier? Are there any covenants or restrictions that you have to follow once you take the money, including how the funds must be used? And last but not least, there might be tax implications you want to consider. So the bottom line is that every business is different, and the considerations will weigh differently at different points in time for each different business. So with that said, then, getting to a right fit, what might be some of the ways that we can determine that for your specific company? And we've got 3 of them here on the slide: a cost of capital approach, sector approach, and life cycle approach. The reality is, as you're thinking about raising capital, you're going to be doing these intuitively, whether you're following a particular model or not, but you're going to be thinking about what is the cost of this capital and how does that weigh into my overall cost? What industry sector am I in, or subsector, and what stage of life is my company at? And we'll look at each one a bit more closely in a second, but just to cover them off here. Cost of capital is a mathematical approach to minimizing the risk reward trade-off of your capital stack. And the optimal capital stack here is one that minimizes your total cost of capital. The sector approach is more about analyzing the capital stack of companies in your specific industry sector and understanding their capital requirements, so that you can see that the optimal capital stack for you is one that looks similar to other companies in your peer group. And then the life cycle approach is about analyzing the capital stack of companies in the same life cycle stage of yours, whether they're startup or growing or more mature, knowing that the optimal capital stack there is one that suits your company at the current stage in its life cycle based on what is on offer. So these are all just a guide, but looking at them in a bit more detail can just give us some things to think about. So if we look at the cost of capital first and plot out weighted cost of capital on the vertical axis and debt to equity ratio on the horizontal axis, you can see that with equity being more expensive than debt being less expensive than equity, that the line starts off, and as the debt to equity ratio grows along the horizontal axis, the weighted cost of capital starts to come down. But at some point, there will be an inflection in that the company takes on too much debt, it's about 60% in this case, and starts to become over leveraged. The default risk to the people that are lending the money starts to go up. They start to charge higher interest rates, and there's an increase in the weighted cost of capital. So as the debt in the debt to equity ratio increases as you go further out to the right, at that point, about 60% here, the overall cost to you as a business will start to go up. If we start to look at the sector approach, so this is the industry that you're operating in, you can think of it in 2 ways: the capital needs of the sector and cash flow profiles. They will vary quite dramatically sometimes from sector to sector, and that's why it's worthwhile analyzing what the capital stacks look like in each of them. So the capital needs side, some sectors are capital intensive by nature and require a large pool of funds up front so they can begin generating revenue, while other sectors can generate revenue without much need for upfront capital investments. If you think about the oil and gas sector, for example, or telecommunications, they've got high upfront capital requirements because of their infrastructure needs. Service companies, on the other hand, have low upfront capital requirements, as most of their operating costs are for ongoing salaries. On the other side of things, if you think about cash flow, some sectors have strong, steady cash flow profiles, while others have a much more sporadic cash flow approach because the revenue generation fluctuates. You think about utility companies, for example, they tend to have very stable cash flows with their customer base. And service companies, on the other hand, are in a different situation. But the utility companies can take on more debt because they've got that steady cash flow profile. If you've got a subscription-based revenue model, you can perhaps prove a consistent ability to generate steady cash flows, so long as you're growing your subscriber base over time. If you're a startup and pre-revenue, then you're not going to have the steady cash flow like the others, and it's going to be harder to access and secure debt because of the difficulty in paying the interest or showing your ability to pay interest over time. But it's not just an either or here. It's all about finding the right mix and consistently assessing what the right mix is for your company at any particular time as you go through that. And we can see that perhaps best in the life cycle approach, as it will change over time. If you're a startup, pre-revenue, as I said, difficult to access affordable debt because you don't have the cash flow to service the debt payments, or for that matter, hard assets to secure the loan against perhaps. So you may be more forced into the other bucket or going down the equity route. As you start to grow though and begin generating revenue, debt starts to become cheaper and more available for you, and the company will have more flexibility with different sources of capital. As you mature, companies with a strong revenue history will be provided cheaper debt options, and the likelihood of defaulting on the loan is less, and people will be more amenable to providing new different options. So you say, okay, well, looking across the equity, debt, and the other buckets, and then those frameworks for different approaches, if I do all that, is that it? Am I done? Have I optimized my capital stack? And the answer is, in a word, no. This is going to be an ongoing process, and very much so. Like the old shampoo adverts said, wash, rinse, repeat. It's an endless cycle. And to illustrate that, we've got 3 bullets on this slide that essentially say the same thing. It's going to be an ongoing process. You will be regularly reassessing it, and it will change over time. So I'll pause here for a second before Julie goes on to talking about how easily fits in. But in conclusion, all the stuff we've just outlined here can give you a strong sense of what capital stack might make sense and how the mix might operate for your company. But chasing it and understanding it will be an ongoing process, and one that you need to do consistently over time.
Thanks, Alastair. And a reminder to everyone, if you have any questions, to please put it in the chat. We have one from Rebecca, and the question is, can you please explain how Innovative Solutions Canada program works?
Yeah, so it's a coming together of, on behalf of the federal government, they've got 2 streams. One is a test stream where challenge stream, where they put out challenges that companies can apply for. So basically, on behalf of different government departments, ICS will pose a question, almost like a research question, to see if anybody in a Canadian company has an idea or a solution that can address that. And they will perhaps give you funding to prove that to them. The other stream is one where there is a proven fit for a challenge, and they typically provide more money into the millions of dollars and essentially act as your first customer and give you a purchase order to actually deliver something to them. So the first case is kind of proving a proof of concept, if you like, that something works. And then the second piece is you get a purchase order and can apply for that.
And so follow up on that then, is it considered as like a sale, or is it a grant?
I would look at it more as a grant. Yeah, it's government money.
But do they have to be paid back, or is it just they give you money and then you?
Yeah, no, they give it, as I understand it, they give you money in order to do what you have agreed in terms of it. So the challenge piece, if they ask you to prove that you've got something that can work for them. And to my understanding, this is kind of more in the $100,000, $150,000 kind of mark, perhaps, for that kind of stuff. They give you the money to enable you to test whether what you have can answer their question. And then in the other piece, they're saying, okay, we understand this will work. Now we will give you a bit more money, which can be in the hundreds of thousands of dollars or into the millions of dollars. And that's more like a first purchase order, where you provide something and get paid for it.
Okay, thanks.
Yeah.
Next, we got two questions from Stephen. So the first one is, you show the WACC as a weighted average of capital cost to be minimized at around 50% debt to equity balance. How universal is that across different companies and sectors and things?
Yeah, it's, I mean, that's difficult to say. I suppose we just used one example here just to show that it will change over time. So
we're going to meet at 3:30. We're not even meeting at 3:30.
We can meet at 3:30 to 4, yeah.
Oh, 3:30 to 4.
There we go. Yeah, this was just one example that we just used to illustrate it. So it will change. You need to do the actual calculations for your individual company.
Okay. Second question from Stephen. As a company matures, risk goes down and cost of debt goes down, but so does cost of equity. So is there a general rule of whether the recommended debt to equity ratio mix or debt to equity mix should go up or down as the company grows?
It's kind of specific to each company, I would say, and each industry. It really depends on a combination. As I said, going through the slides there, it's a combination of all those things: what industry you're in, what your peers are doing in that industry, as well as what life cycle stage you're at. And if you think about what would be attractive perhaps to an equity investor, you'd be looking during your diligence phase as to what sort of revenue streams the company has today, as well as what contracts they have coming up or things like that. So all those things will be very individual to the specific company, and that will help answer the questions.
And again, a reminder, if you have more specific questions that you want to go a little more deep after the presentation here, Julie and Alastair are welcome to, or open to staying and sharing a little bit more advice then. Another quick question from Stephen here then. For a lot of startups, I think the optimal mix in your stack is whatever you can get your hands on.
I completely agree. Absolutely. And on that note, Julie will take us into something that is very easy to get your hands on as we look at how easily fits into all of this.
That's almost like it was a perfectly planned way.
Excellent.
So thanks, Alastair. And now I'm going to get into a little bit about how easily can help you fit into the mix. So as Alastair said, optimizing your capital stack is going to be a continuous and ongoing process. It's important to make sure that your company has the capital it needs today and also in the future. So as your company continues to grow, you should always be looking at different sources of capital and compare their direct and indirect costs for your business. If you receive a SR&ED refund or have been approved for or received a government grant, financing could be a great addition to get working capital in your hands right away. If we take SR&ED financing as an example, it's a low-cost debt and it has a short life cycle of about 6 weeks to 9 months. And we only take priority on your SR&ED refund, which doesn't impact your ability to raise additional capital as we're not taking other priority securities. So from our perspective, we're certainly not going to ask you to sign over your house. And the last thing that we want to do is to take a piece of your company away from you. The financing options that we provide are always non-dilutive. So let's talk about how Easily is innovating in this space. We offer capital as a service to give you flexibility with your money. If you receive SR&ED or have a government grant, ask yourself the following questions. Would you prefer to have the money in your hands or in the government's hands? Do you want to go into your next year knowing that you have money to spend in your reserve? What would you do if you had this money right now? Would you hire more staff, start a new project? Or would you just be more comfortable knowing that the funds are in your account and ready to use if and when you need them? How does it all work? So with Easily, our application process is fast and easy. It only takes about 10 to 20 minutes to complete. So the first thing you'll need to do is to go online, fill out an application form with some basic company background and information. Next, you'll connect your banking and accounting information to our secure platform using APIs. And once we review your application and confirm your eligibility, we'll send over a funding agreement, which is really straightforward and easy to understand. So at Easily, we don't play the terms game. Our terms and conditions are the same for everyone, and we don't negotiate them. And the reason we do this is because it allows us to streamline our process and process your application very quickly. Once the agreement is signed, we'll deposit your funds right into your bank account, and then you're done until your next draw request. The entire process takes about 2 weeks or so from start to finish. And you might be thinking, great, this all sounds great, but what is all this going to cost me? So we're really transparent about our costs, and we have no hidden fees. We will advance you 75% of your SR&ED refund on demand. No matter where you are in your year, you can access the funds. Most of the companies we work with draw quarterly because they like to get predictable cash flow throughout the year, but really you can draw anytime that you need to, up to 4 times a year. There's no facility fee, and you're only paying for what you use. We charge 1% draw fee on all of the advances, and our annual interest rate is 14%, which works out to 1.16% per month. The reason I say the monthly amount is because loans typically are never outstanding for a full year, and the standard use case for a company that draws 4 times a year is anywhere between 5 to 10% of interest. It's hard to compare our costs with the competitors because we don't charge any extra fees or an application fee, but I welcome all of you to reach out to us directly, privately, to determine what your cost of borrowing would be for your SR&ED or any grants. And finally, why do customers choose Easily? So some people come to us simply for bridge financing, but more and more companies are choosing us because we can give them quarterly and predictable cash flow. Some of them are coming to us because they want to turn a government receivable into cash flow on their balance sheet. We can approve our clients in about 48 hours, and we do accept first-time filers. We have excellent customer service, and we're backed with a large amount of institutional capital. Our goal actually this year is to inject $100 million into the Canadian economy. We have enough funds to service every person on this call at least 100 times and much, much more. So our non-dilutive financing is always cash flow positive, and it's designed to complement a company's capital stack with transparent terms. In a nutshell, we are efficient, we are reliable, and we are affordable. So we'd like to invite you to contact us to get your money today. It's definitely going to be better in your hands, and the CRA isn't doing anything with your money. So we'd like to open the floor to any additional questions that you might have.
Thanks, Julie. That was great. While people might be typing up, I'll throw a couple questions here. So you talked about SR&ED a lot, and I think people are fairly familiar with that, but is it just SR&ED, or you mentioned some other grants? Can you kind of elaborate a little bit more on that?
Yeah, absolutely. So we did talk about SR&ED, and we do have standard terms for SR&ED. We will work with companies that have received or have been approved for a government grant. We look at those on a case-by-case basis. So we would just need your funding agreement. So we work with grants like SDTC, NGen, SIF, the Interactive Digital Media. So if you have a grant from the Canadian government, we can finance it.
Yeah, so just to expand on that a little bit, as Julie says, the SR&ED program, as long as your R&D spend is SR&ED eligible, it's pretty formulaic. You'll go through your spending during the year, file your tax return, and then get your CRA refund. So our approach to that is very similar, it's very formulaic. But because each grant program is different and each grant award may be different in terms of not only the amount of money that's received, but when it's received and what milestones have to be hit in order to trigger payments, perhaps if it's a reimbursement situation, that kind of thing. That's why we look at that more on a one-off basis. So when we finance companies, say, that have if you got $1 million award from Sustainable Development Technologies Canada, SDTC, there will typically be tranches of that money advanced whenever you hit certain milestones. So the way we tend to work on that is we'll give you an advance on your first advance, and then you'll apply to get your advance back, get your first milestone payment from that, and then we can advance you on your second milestone payment. So it's much more short-term finance. It's kind of 3, 4, 5 months worth of cash flow injection in those situations rather than a longer term thing.
And we'll also look at financing current and one tranche ahead is what we'll look at financing.
Yeah, I've heard a lot of good things about STDC, but that it is spaced out like that can be definitely challenging. It's a very long project, so definitely having the cash earlier on. Is it only Canadian funds or federal funds, or is there any interaction with any provincial grants or US-based opportunities?
Yeah, so I mean, the short answer to that is wherever there's a Canadian government paying the bill. So we will provide that. So we work with Canadian companies and Canadian governments, but it can be provincial, federal, municipal even. So if there's a government paying the bill, that's what we're taking our security on. The only security we take, as Julie said, we're not looking for personal guarantees or other securities or anything else. The only collateral we take for the easily advance or the easily loan is on the government receivable that you have as a company.
And the company does have to be a CCPC.
Right, and can you remind everyone what that is on the call?
So that's a Canadian, go ahead, Alastair.
No, I was just going to say, yeah, Canadian controlled private company, which means you're eligible for a refund from the SR&ED program rather than just an investment tax credit to be applied against future profits. You have to be a refund there. You have to be a Canadian controlled private company to get the refund.
Yeah, exactly.
Quickly for those on the call and listening, if you're maybe able to raise your hand to indicate if you are a founder, I'll have to do a quick little poll here. I don't know if the raise hand feature might be easier to see. Not everyone's on video here.
Very good. It looked like Rebecca had a question. I think she was putting up.
Oh, it's okay. I was just looking for clarification. So just so I understood. So in essence, we would go and get approval from SR&ED and they would approve the project. Once we have that approval, we come to you guys loan us the money up front so that we can hire the people right away, right? Is that in essence what you were saying?
Yeah, absolutely. So there's two different ways that you can do it. Either you're self-filing or you're working with a company that will help you prepare and file your SR&ED. So let's say, for example, you're working with a company and they give us that number, what they're comfortable with from a SR&ED perspective. You don't even have had to file yet with the CRA. Once we have that information and the other documents we need for your application, we can absolutely look at financing 75% of that to you right away.
Okay, thank you.
You're welcome.
So to confirm, you're typically not preparing the files themselves, right?
Correct.
It's done. Okay.
Right. Yeah. Easily is just purely a lender, purely in the financial services business. We're not in the tax filing or tax preparation business. But our clients are either, as Julie says, they're either self-filers and doing the SR&ED tax preparation and filing themselves, or they're working with a SR&ED consultant or their tax accountant or accounting firm, something like that.
And if you don't have one, you can reach out to us. We work with many companies across Canada and would be able to match you with somebody that would be a good fit for your company.
And then just to clarify too, because I think there are a number of early stage founders on the call, if you haven't filed or if you haven't submitted a previous SR&ED claim, easily still accepts those clients. Is that correct?
Absolutely, yeah. So we'll still do our diligence process, but we do accept first-time filers. Absolutely.
Yeah, so first-time filers, pre-revenue companies, all accepted by easily.
Perfect, because I do know a lot of the other options out there. You need either 1 or 2 or 3 years of SR&ED claims that they're willing to back and support, and for early stage companies, that's not super helpful. So right. This is, I think, a great solution for this stage of financing.
Exactly. Julie, it might make sense, just as people are maybe thinking of more questions, we can flip to that first reinvestment slide that we have. So this will look a bit complex perhaps, but let me just talk you through it. And as we said earlier, Julie and I are available after the group session here today or on an individual basis later on. But there's a kind of a flywheel effect when Easily provides money on a quarterly basis to companies for their shred in this example. So if you think about, we try to make the math fairly easy here, but in the top chart, we've got a status quo, companies spending $100 in shred eligible R&D. In the normal course of business, they'll spend that money and then they'll get to the end of the year, file their tax return and wait for a CRA shred refund of say 60 cents on the dollar. So out of that $100 of shred eligible R&D spending that they start with, they'll get $60 back, which is good, right? That's what the whole program is designed to be. But if you go through the math with Easily, you start with that on the bottom piece for the Easily client, you start with the same $100. And as you go through, knowing that you're going to get 60 cents on the dollar back, Easily will advance you after your first quarter 75% of that $60 shred refund. So that's that green column. You get $45 back at the end of the first quarter. And the same thing, again, you'll get $20 back of that same amount at the end of the next quarter, and then another $9. So during your year, your $100 in shred eligible spend with the Easily advances has actually grown to $174. So that by the time you get to the end of the year, your shred refund is no longer just $60, it's $104. So that's the kind of flywheel effect that I talk about. And obviously there is a cost to that, but in this example, the cost is $10 out of that, so 10% of the refund. So the real question here is, in thinking about kind of back to our optimal capital stack and what's the mix like and what money can you get your hands on as a startup and all the rest of it, it essentially, if you could answer the question, what would you do if you had the money sooner, by saying, well, I would hire another developer, I would get the product to market sooner, or anything like that. You know, what is the real benefit of having that cash flow at the end of quarter one instead of at the end of quarter one or quarter two, a year away when your shred refund comes in? That's what Easily is set up to do. And it's all done very quickly, as Julie said, in the how it works piece in the process. The application, all fully digital online, very simple to go through, and then funding starts to flow within 1 to 2 weeks for approved clients.
There's a question from Sarah. What happens if the shred filing is audited and not approved, and or the claim turns out to be less?
Yeah, so the part of the answer to that is that's the reason Easily lends 75% of what your shred spending is, in order to be able to pay a consultant if you're using a consultant, to pay the interest charges for Easily, and to give some sort of leeway if there's a bit of a knockdown or knockback from CRA. And I have to say, we will lend up to 75%. So we do look at each company's position on an individual basis, and we want to be confident, either from speaking with your own company people as well as your shred consultants and looking at it from our perspective as to what will pass through CRA. At the end of the day, if it is caught in an audit and that extends the time, then the loan from Easily, the advance is outstanding for a longer time than that.
But at the end of the day, if for whatever reason your claim was rejected, it is still a loan, so you still do owe Easily the money back at the end of the day. However, since we've been in business, I don't think that's happened once, but that's what
yeah, frankly, we're not in the business of lending money to companies with risky shred claims. It doesn't make sense for the company, it doesn't make sense for us. So we do our diligence at the front end, but it's a pretty quick process.
So you've got a pretty good track record, and maybe there might be some drops occasionally, but outside of that margin of error, your claims are typically successful.
Yeah, we certainly never had a refund rejected.
Great. Are there any final questions?
We have turned down people for financing because we didn't think they were ready, or we didn't think it would go through CRA. So, but once we've accepted them, we've never had one rejected.
Great. Are there any final questions from the audience? With that, again, I'll give a big virtual round of applause to Julie and Alastair. Thanks so much
Thanks,
for
everyone.
providing this information. If you want to maybe put back the slide with your contact information.
Will you be able to send out the slides?
Yeah, absolutely. So
Yeah,
no, we'll do that.
Yeah, we'll send out the slides and the recording as well to all those who registered.